All right, guys. It's a beautiful evening, and I'm so glad to welcome you all to yet another beautiful session where we're going to be looking at a beautiful standard in the name of IS number 23, a standard that tells us a lot about borrowing costs. So, guys, as usual, it's always awesome to see you. I'm so glad to see you guys. Are you guys doing fine? Are you guys fantastic? Everybody, are you guys okay? Are you guys doing well? We have Mr.
Hi, thanks.
Hangova.
How are you, sir?
I'm all right, thank you, sir. We have Albertina, Mumbake Mwape, Vincent, and everybody else. Guys, are you guys okay? Okay, we have Mother Esopiri from Facebook who says he's watching from Luansha. That's fantastic. It's always good to see you, Mr. Piri. Thank you so much. So, guys, we go right ahead into the main meal for tonight, and all right. So, yeah, I can see some comments from the group from Ruth who says I'm okay. Helen from the group and Mr. Ango. All right, guys. I may want to make use of your voices and for this session. So much of your voices. All right. Okay, guys. So we continue now with our beautiful standard. Our beautiful standard. So, guys, borrowing costs. Now, remember what we always say. I usually give all of you. I usually give all of you what I would like to call. I usually give all of you a formula that we use when doing the standards. And also for the purpose of this standard, we are still going to use the same specific formula, the ARM. So guys, let's go and look at IS number 23. So IS number 23 is a standard about borrowing costs. Now, I must mention to you guys that borrowing costs is a standard that is highly examinable. Last semester, we saw an exam question on borrowing costs. And you must be sure that even the coming semester, this standard is going to pop up, is likely to pop up because the examiner loves a standard like this one. So, guys, what really are we talking about when we say borrowing costs? What really are borrowing costs? So remember what we always say here. So I'm going to tell you from the outset that before doing any standard, you first have to understand the formula which I happily invented. You can call it the SL formula, the ARM. So the ARM is a formula that we use. And the ARM represents the following. Meaning of ARM. The A is the about, the R is the recognition criteria, the M represents the measurement. You must also note that disclosures are important too on every single standard. So the ARM, the about, the M, the R, the recognition criteria, what an item must meet for it to be recognized in the financial statements, and then the measurement talks about the numbers, the accounts, how much do we put in the accounts at this particular time. So that's about the measurement. So now, guys, let's use the formula because I want to remain faithful to my chosen formula. So let's use the formula to explain IS number 23. Let's use the ARM. So you guys who are watching us on Facebook, please share this video in different groups so that as many people as possible can be able to join us. Please share the video. Help us by sharing this video right now. All right. So guys, what we have here is the following. Remember, the standard IS number 23 is about a lot of things. So what really is IS 23 about? Well, IS 23 is a standard which deals with borrowing costs. And it tells us about the treatment of borrowing costs incurred for the purpose of financing a qualifying asset. So this standard deals with borrowing costs, but also tells us, hey guys, I'm going to give you guidance on how you should treat the costs incurred specifically for purpose of financing a qualifying asset. So if you can see, I have put the words qualifying assets in capital letters for you to understand that it's very important. That statement is important. So if we are to go forward, in short, what we are trying to say here is that borrowing cost refers to interests incurred by an entity on borrowed funds. Now, specifically for the purpose of financing a qualifying asset. So when a company incurs interest, that when a company borrows funds from the bank charges interest. Now, those interests that the company incurs specifically for those borrowed funds, which are meant for financing a qualifying asset, is what we refer to as borrowing costs. So, I need you to understand something here, guys. You must kindly note that borrowing costs is not limited to interest only. No, some people only think when we talk about borrowing costs, we only refer to interest. No, that's not what we learn. It is also associated to borrowed. It is also associated to costs that are linked to borrowed funds. For example, advertising costs and any other costs that are directly attributable to borrowed funds. Those ones can also be capitalized. So if, for example, you want to sell your vehicle, you may incur certain advertising costs because you want to sell a particular vehicle, a particular asset. All those costs must be added to the cost. You don't neglect them. So we're not just restricted to borrowed funds, but also we want to understand that there are other things that might be added. Bana Shalin watching from Kabwe, thank you so much. It's good to see you, Bana Shalin. So guys, so there we go. So we can continue now. Let's talk about the differential borrowing costs in a much more deeper detail. Remember what we said. How did we define borrowing costs? Remember, we said that these are costs that are specifically incurred for the purpose of financing a qualifying asset. So what then, guys, is a qualifying asset? What is this? What is a qualifying asset? Guys, from Facebook and from class, please, I would like when I ask a question, just type in the comments so that I know, what do you think, guys, a qualifying asset? Give me some comments. Let me hear from you. Because we are saying that borrowing costs, these are costs incurred specifically for the purpose of financing a qualifying asset. Just tell me what you think. What do you think is a qualifying asset, guys? Let me know from the comments. Tell me what you think a qualifying asset is. That would be so much nice. That would be so much nice to hear from you. What is a qualifying asset, guys? What do you think? What do you think is a qualifying asset? Well, because I'm such a very nice man, I'm going to tell you. A qualifying asset is one that takes a substantial amount of time to complete or to be made ready for its intended use or sale. But if you notice there in my definition, our definition, we have said an asset that takes a substantial amount of time. What does that mean? Substantial amount of time may mean a period more than one accounting period. So it's not something that you build in a few months. So we're talking about big assets, maybe hotels, lodges, such kind of big assets. We're talking about power plants, those big assets, not just any simple asset. It must be something that takes a substantial amount of time to complete or to be made ready for its intended use or sale. So that's what we're referring to as a qualifying asset. All right, so we have somebody there saying awesome. All right, that's good. Yeah, it's good to see somebody's enjoying. All right, guys, so there we go. Now notice something here, guys. Remember, there are some examples of a qualifying asset. We are saying it must take more than one accounting period. So the examples of those assets could be inventories. It could be manufacturing plants. It could be power generation facilities and investment properties. So those are the type of assets that we are referring to as qualifying assets. Assets that take a substantial amount of time to complete or to be made ready for its intended use or sale. So it's important to understand that inventory in this context may not necessarily mean those kind of inventories which are used in day-to-day activities. No, we're not talking about those kind of inventories. We are going to go in a bit more details as we go further on this particular standard. So, guys, is there anything else we can talk about on this particular asset? Remember, we've talked about what a qualifying asset is, and we've given some examples. One of them is what you're saying a manufacturing plant, power generation facilities, investment properties, and things like that. So the question that we have then is, remember we're talking about borrowing costs being costs incurred specifically on borrowed funds that are meant for the purpose of qualifying what of financing a qualifying asset. So this now begs the question to all of us: when do we capitalize these borrowing costs? At what point do we go in our books and capitalize these borrowing costs? Now, the standard gives clear guidance in the following simple terms. The standard tells us that you can only capitalize borrowing costs when borrowing costs are being incurred. Then you can capitalize. When expenditure on the asset is being incurred, then you can capitalize. When activities that are necessary to prepare the asset for its intended use or sale are taking place, then yes, you can capitalize. So the standard gives us guidance. It only says there are only 3 ways which allows you to capitalize borrowing costs. And you've outlined all those 3 ways on the screenshot and on the notes that are running on your screen. 3 ways only. When borrowing costs are being incurred, that is 1. Number 2, expenditure on the asset is being incurred. Number 3, when activities necessary to prepare the asset for intended use or sale are taking place, then we can capitalize. So we have something else. Now, when do we stop capitalizing these borrowing costs? Are we going to capitalize forever? Guys, let me know, what do you think? When do we stop capitalizing? Guys from Facebook, tell me in the comments, what do you think? At what point do we stop capitalizing these borrowing costs? Yes, guys, what do you think? At what point are we going to say, all right, enough is enough. Now let's stop capitalizing these borrowing costs? So when do we stop capitalizing, guys? What do you think? I want to hear from you guys. Let's ask guys from Facebook and guys from class. Guys, when do you think we should stop capitalizing? Let's begin with Mr. Vincent. Mr. Vincent, what do you think? When do you stop capitalizing these borrowing costs? I have a question. What do you think, Mr. Vincent? At what point do we stop capitalizing? When do you stop capitalizing? Anybody from class, guys? Mr. Vincent, Mr. Angova, anybody? At what point do you stop capitalizing? Please, I need to use your voices because I can't, some of your texts, I can't really see them immediately. When do you stop capitalizing? At what point do you stop capitalizing? All right, so we have a comment here from Facebook where Taisia says, when asset is complete. I think that's a beautiful comment. When asset is complete. Guys, how about you from class? What do you think? And we want to agree with that comment because it is true. We stop capitalizing when the following things happen. Now, when asset is complete, that's number 1. Yes, we stop capitalizing. Number 2, in the exam, what the examiner does is going to tell you that there was an interruption during the year. Maybe employees went on strike, or there was an hurricane or a storm, whatever it is that happened, a major interruption. Then we must stop capitalizing. But you must also note, guys, that where asset is completed in parts or stages, capitalization should cease for each part as it is completed. So the part that is completed, you should stop capitalizing it. Then you begin to focus on the other one. It is completed again, you stop capitalizing. You focus on the other one. So you must capitalize in parts as that is being completed. Like for example, if you're building, if you are constructing an aeroplane, So you find that the dough is made in Canada, the base is made in China. So you keep capitalizing as the asset is being completed in parts. For those that are completed in parts, that is what the standard tells us. But remember that the standard also tells us something interesting. The standard IS number 23 tells us also about disclosures. What must we disclose when we are dealing with borrowing costs? Well, number one, the standard tells us that we must be able to disclose amounts of borrowed funds during the year. So it's important for the shareholders to know how much did you borrow during the year. But also, apart from that one, the standard dictates that also you must be able to disclose what is called capitalization rate used to determine the amount of borrowing costs eligible for capitalization. So if you're going to say the borrowing costs in total were 10,000 or 10 million kwacha or $10 million US dollars, what rate did you use to whatever that amount? We are going to do a calculation tonight that's going to help us understand that point. So it's important to remember that. Is there anything else that we must be able to remember? Yes, there is something else. Something else that we need to understand, guys, is this. Let's go to the measurement. Because we now talked about the disclosure, what standards about. So we have dealt with the A, the about, talked about a few things. Now let's go to the recognition criteria. At what point do we recognize those borrowing costs in our financial statements? At what point do we just wake up and say, hey guys, we're going to recognize these ones? No, we don't do that. So at what point? What do you think, guys? Let me know what you think. At what point we recognize? Guys from class, what do you think? At what point are we going to recognize the borrowed funds? Those of you from Facebook and YouTube, let me know what you think. At what point do we recognize those borrowing costs? I want to hear from you. Let's go with, let's ask Albertina. Albertina, at what point do you recognize those funds? What do you think? At what point? Yes, Albertina? You may want to unmute your speaker, please. At what point do we recognize those borrowing costs? Mr. Mumba? Guys, give me some feedback. At what point? If you don't know, it's okay. Tell us you don't know, we move on to someone else. At what point, guys from Facebook, what do you think? At what point do we stop recognizing those borrowing costs? What do you think, guys? Mr. Angova, anything?
No, I'm not sure on this one.
Anybody from Facebook, guys, what do you think? At what point do we stop recognizing those borrowed funds? What do you think, guys? What do you think? At what point do we recognize? And at what point do we stop recognizing? So maybe let's begin with at what point do we recognize? At what point, guys, are we going to recognize those borrowed funds? Maybe let's begin with that. At what point, guys? Yes, Kutemba, what do you think? Yes, guys, what do you think? Guys, are you guys serious right now? Because we talked about this earlier on. I gave you something earlier on. So the comment here says when borrowing costs are incurred, yes, that is true. And we talked about this one earlier on, guys. Please, guys, give me some feedback. We talked about this earlier on. We said that recognize only when borrowing costs are being incurred. That's number one. Number two, when expenditure on the asset is being incurred. Number three, when activities necessary to prepare the asset for its intended use or sale are taking place. Then you can recognize those borrowing costs. So we said this earlier on. This is why I'm so surprised you guys can't tell me what we just said a few minutes ago. So that is when you begin to recognize. But now, this time around, I want us to go in a bit of more details. What do we mean when we say when expenditure on the asset is being incurred? So you must remember here, guys, that the statement expenditure means you are actually paying cash, or you are transferring an asset or an interest-bearing liability. So the statement expenditure being incurred is not simply limited to paying cash, no, but it's also extended to what transfer of assets or transfer of interest-bearing liabilities. Those could refer what we're talking about in terms of expenditure being incurred. All right, guys. Is there anything else that we can talk about? Yes, there is something else that we can talk about. Anything else? There's a statement on that explanation again, which says when activities necessary are taking place. What does that mean? Now, when we say activities necessary taking place, we're talking about not only the physical construction of the asset, but also this extends to administrative works. For example, you may be busy running around obtaining payments from the government or the authorities. All those costs that you're going to incur, all those activities should be added, should be counted as activities necessary for making the asset complete or be made ready for its intended use or sale. So all those ones must be particularly considered. So this may extend to quite a number of things. But again, let's finally move on to something else that the examiner is going to bring in your exam before we do a calculation. So I have an exam question we're going to do tonight. But before that, let's talk about the M, the measurement. So we talked about the A, the about, the coefficient criteria. Now we're going to the measurement. So what is this about, the measurement? Now, ask number 23, guys, states that in situations, notice, in situations of general borrowings. Now, here's what the standard says. Notice, the standard says, it says that in situations where you are going to use general able to use what is called the weighted average interest rate. So there's what you call specific borrowings and general borrowings. If we talk about specific borrowings, what we mean you have a loan just with one bank. That is a specific borrowing, just one source. You just go to maybe FNB or Zanaco or Atlas Mala, whatever bank that you feel is good for you, ABSA, and then get a loan from them. That's specific borrowing. But when we talk about general borrowing, what we are talking about is that you've gotten loans from different sources. Kubanki, Kubeport, you've gone to a bank, you've gotten a loan, Beport, different banks, you've got a loan. Please, you must remember those ones, you have to be able to use what is called specific borrowings. You have to use what is called weighted average interest rates. So we are going to do some questions now so that we can understand these two concepts. How do we treat specific borrowings and how do we treat general borrowings? So we must now do a question. So I hope you guys are ready to write something down so that we can do all these particular questions. So I have two exam questions that we need to look at right now so that we can further gain a proper understanding of specific borrowings and general borrowings. So the first question we are going to deal with is on specific borrowings. We are going to do some calculations, and then we are going to go back to another question, which is going to be about general borrowings. I want you to remember two important things before. If you are dealing with specific borrowings, just use the effective interest rate. If you are going to deal with general borrowings, use the weighted average interest rate. So there are two important things: specific borrowings, effective rate; general borrowing, weighted average interest rate. So let's go and do this particular question now. So we have a question in front of us here which says the following. It says it's on specific borrowings actually, and it says Mapesa PLC started to build a plant on 1st February 2019. So February 1, 2019, this company begins to build a plant. Now, this construction was funded by a 15 million kwacha loan with an interest rate of 5%. So there's 15 million kwacha loan. Those of you from YouTube, some of you are from different countries, you may take it to be dollar. Yeah, $15 million. So we're looking at 15 million kwacha loan with an interest rate of what? Of 5%. The exam also tells you during July, construction was stopped. So there's a reason why the examiner tells you that. There's a reason why the examiner says construction was stopped. The reason it's not for fun, it's for you to understand what is actually going on. So guys who are watching us, please share this video in different groups. Please share the video, help us. And then the examiner asks you a question. He says, required, calculate the amount of interest Mapesa PLC must capitalize as of 31st December 2019. So the examiner is asking to calculate the amount of interest this particular company should be able to recognize at 31st December 2019. So let me take you back to the question for us to understand it. Notice something here. This company started building a plant in February 1, 2019. The interest rate is 5%. In July, construction was interrupted. It was stopped. So you have to remember what we talked about earlier. When do we stop capitalizing? We said one, when the asset is completed. Then number two, we said when there's a major interruption. Number three, we said we talked about those assets which are completed in parts or in stages. When the stage completes, we stop capitalizing it as that particular stage. So now let's go to the solution here. How much interest is this company going to recognize at 31st December 2019? Look at that solution right there in your screen. So what we have to do in the exam here, step number one, we must first determine the number of months for capitalization. It's very important. We can't just go on a rampage capitalizing everything. First of all, we must be able to determine the number of months for capitalization. How many months do we have to capitalize? Once we determine the number of months for capitalization, what else do? We go to number two. But here, notice, when determining the number of months, you must kind of assume a full year, and then you less months without activities. So you have to assume that the construction is taking on in a full year. Don't start counting from what the examiner tells you. Just assume a full year every single time. Assume 12 months, and then less those months without activities. So here we assume a full year, and then we remove a month without activities. So that makes it more sense. Now, if you look at this one here, we have been told that July had no activity, was interrupted. So that means from the 12 months, we are going to remove July. Now that leaves us with how many months? With 11 months. Now notice that the examiner told us something. The examiner told us that the construction started when? On 1st of February 2019, which means January also had no activity. So we remove January because in January we had no any activity. So we've removed February where there was an interruption. So February is gone. So we go to January, also January is gone. That leaves us how many months? It leaves us with about now 10 solid months. So we are going to capitalize interest only for 10 months. You must not make a mistake in the exam. Always assume a full year, then remove months without activities. All right, so there we go to step number 2. Now that we have 10 months. So step number 2 now, we must calculate the interest for capitalization. So in this context, the full loan amount that this company collected, remember, this company got how much? The examiner told us that this company got a 15 million loan, 15 million kwacha loan. That's what this company got. So what we do, we go to step number 2, we capitalize that one. So we are going to get 15 million, we multiply by how much? By the interest rate. The examiner said the interest rate for this particular loan was how much? He said it was 5%. So we're going to multiply the full loan amount, the 15 million, we multiply by 5%. That also is going to be multiplied by 10 months over 12 months. So we get the 10 months and now we multiply by 12 months. Now that leaves us how much with 0.625 million kwacha. If that is okay, guys, is that okay? So that we move on. If you have any question, guys, please feel free to ask. Feel free to ask. Is that okay? Before we move on, guys, I want to hear from you. Is that okay, guys? Is that okay? Guys, give me some feedback. If that is okay. We are doing a specific borrowing. Is
Yes,
that
that's
one okay? Before we go to general borrowings. Is that okay? Guys, is that okay? Guys from class, you can tell me your voices, please. Okay, somebody says, Mr. Vincent says, I'm okay. Mombak says, yes, I'm following. I don't need you to follow, I need you to tell me if it's okay. Following is not enough for me. Yeah, so anyway, what was this? Okay, Helen says, I'm okay. Okay, fantastic. All right, so Mr. Mumba, Mr. Vincent, and Helen, they confirm that they are okay. Okay, that's good. All right, so let's continue. So if that's okay, now let's go and do a second question. Now, this question is on general borrowings, where you go and borrow from different sources. There are people who are like that in practice. They wake up, they go to the neighbor, they borrow money. From a workmate, they borrow money. At the bank, they borrow money. They go to the Shylocks, they also borrow from Shylocks. There are people who are accustomed to that. All right. So Paul Manda Jr. from Facebook says it's okay. It's good to see you, Paul. How are you? It's good to see you. So guys, so there we go. So now we go to general borrowings. All right, so question number 2 is about general borrowings, and it reads as follows. SLPLC started to build a new plant on 1st April 2019. You must always pay attention to the dates. SLPLC has 2 loans. Loan number 1 is a 10 million kwacha 7% bank loan. Loan number 2 is a 5 million kwacha 10% bank loan. So those of you from YouTube, you can just, where there's kwacha, you can add dollar. Yeah. Now, SLPLC used 3 million kwacha of existing loans on 1st April 2019. And that's what confuses students. Whenever they see they used 3 million of existing loans on 1st April 2019, what kind of loans are these existing loans? Some students would ask something like that because they're just surprised. Then the examiner also goes on to say, and 4 million kwacha on 1st of August 2019. So you see, the examiner tells you 2 important things. It tells you that this company got 2 bank loans. One of them on 1st of April, they wanted to build an asset on 1st of April 2019, that plant. They went to the bank, got 2 types of loans. One was the 10 million bank loan at 7%. The other one was a 5 million bank loan at 10%. But also the examiner tells you SLPLC used 3 million kwacha of existing loans on 1st April 2019. And 4 million kwacha when on 1st of August 2019. So the examiner asks you calculate the interest to be capitalized on 31st of December 2019. See? So the examiner tells you something like that. Now here, remember what we said earlier. We said when the examiner gives you a question like this one, you must remember that important point. We said the standard S number 23 tells us that in an event that we have a general borrowing question, we must remember that the interest rate to be used should be the weighted average interest rate, not what we did on specific borrowings. On specific borrowings, we use the effective interest rate. It was very straightforward. So here we don't do that. So let's go back to the solution now and work it out. So there we go. That's our solution there. That's our solution there. Okay, Susan Kachali, following from Ndola. Okay, that's Ramake Mumbi, Wana Mumbi, the wife to the government. It's good to see you, Wana Mumbi, following from Ndola. Fantastic. So there we go, guys. That's my bay. Can you believe that? That's my bay. Okay, guys. So there we go. So what we have here, now we have solution. So step number one here, we are going to calculate the weighted average interest. And this is what you must not forget in the exam, how to work out the weighted average interest rate. It's extremely, extremely important. So how do we work out the weighted average interest rate? All we do, we are going to get the first loan. The first loan was 10 million kwacha at 7%. So we are going to multiply 10 million kwacha at 7%. The same way the question says it. See, the question says 10 million 7% bank loan. We get 10 million, we multiply by 7%. And then we'll do the same. We go to the second loan. The second loan was how much? Was 5 million at 10%. So we get 5 million at 10%. We get those answers. So once we get those answers, now we are going to have, okay, this is where I need more attention on weighted. All right, fantastic, Paul. And this is where all of you need more attention, guys, not just Paul Manda Jr., but all of you, because this is where the people in the exam just mess up things. If you can get this one right, man, you are safe. We have no problems in the exam. So now notice what is happening here. So there we have multiplied the 10%, the 10 million with 7%, and we get 0.7 million kwacha. Then we multiply the 5 million with, of course, 10%, and then we get the 0.5 million kwacha. Now here's what happens. This is where the key is. You must not be able to add the two outcomes, the 0.7 plus the 0.5, which gives you the 1.2 million kwacha. So that becomes your total interest. So you're going to get your total interest, and now you're going to divide by the total loan amount. Remember, the total loan amount in this question, the examiner said that the total loan amount was how much? Was 5 million plus 10 million, which gives us a total 15 million. So the total loan amount must be now divided into the total interest. So what we are going to get now is what we are going to call the weighted average interest rate of 0.008% or simply 8%. Guys, if you've not understood on this part, I'm ready for your questions. Please ask me now. If you did not understand anything or you need more information on this one, this is the chance to ask me. I'm ready for you to ask me now. Any question from anybody who did not understand? So I'm going to give you a minute or so for you to ask me if there's any question so that we can respond to it. Is there any question, guys? Anybody who has a question? This is the part where you ask a question so that I'll be very much happy to be able to respond to any question. Mr. Paul, are you okay? You said so I need to pay more attention. Are you okay? Are you okay? Guys from class, any question? You can either say it or you can simply type on the comment section for the class. I should be able to see you. So guys, any question before we go to step number 2, because we have step number 2 coming through? Is there any question before we go to step number 2, guys? Any question? All right. Okay. Okay. Is there any question, guys? Anybody with any question? Before we go to step number 2, I'm going to give you a minute to think about what we have done so far, so that you can be able to ask me if at all there's anything that is to be asked. If you guys are all clear, let me know. Is it clear, guys? You can just type yes. We can move on. We move on. Yes, yes. Yes, I can hear you. Yes.
Hello.
Yes, yes.
Hello.
Yes, yes. I can hear you. Any question, guys? Any question? Yes. Any question? Okay, so we have a question from Facebook. We have a question from Facebook, guys. Let's look at the question from Facebook, and then all right. So let me check out. There's a question on the group. I'm a bit behind on how 8% is found. That's Mr. Mumba says it's behind on how 8% is found. All right. So how we are finding the 8%, Mr. Mumba? We are working out the weighted average interest rate. So what we are doing, since the examiner has told us that these guys got 2 different loans. One was 10 million, one was 10 million at 7%. The other one was 5 million at 10%. So what we are going to do, we are going to come up with the weighted average interest rate. So we are going to multiply the 10 million by 7% plus the 5 million by 10%. Have you seen? So what we did somewhere there. 7% multiplied by 10 million, we have 0.7 million. Then we add 5 million multiplied by 10%, we have 0.5 million, which gives us a total of 1.2 million. So we get this total interest rate, interest of 1.2 million. Then we divide it by how much? By the total loan amount, which is 5 million plus 10, which gives us, of course, 0.008% or 8% simply. So we simply get the total interest and then divide by the total loan amount. Is that okay, Mr. Mumba? Is that okay? We move on. Okay, Mr. Mumba says yes. Okay, fantastic. So now let's move on. Mr. Mumba says that is very much okay. Okay, so now we can go. So we can go to step number 2. So now step number 2 here, we are going to calculate the interest for capitalization. So how do we do that? Remember what we were taught in the question. This is where now that 3 million formula comes in play. The examiner said something interesting. He said, SLPLC used 3 million of existing loans on 1st April 2019 and 4 million on 1st August 2019. Have you seen? So this is the part where you now come and multiply these figures by the weighted average interest rate. So here you are going to say the 3 million multiply by 8%, and then multiply by the what? The number of months. Remember what we said earlier. You must assume a full year, 12 months, and then remove the months without activities. So if SOPLC used the 3 million on 1st of April 2019, how many months do we have without activities? How many months are those, guys, without activities? How many months are without activities?
3 months.
Guys, how many months without activities? If
3
SOPLC had
months.
used 3 million of existing loans on 1st of April 2019, how many months do we have without activities if we assume a full year? How many months?
3 months.
Very good, 3 months. So that means we have a total remaining of how many months? Of 9 months out of the 12 months. So we are going to multiply the 3 million, multiply by 0.08%, multiply by the 9 months, which are the activities over the total 12 months, which gives us a total amount of how much? Of 0.18 million in interest to be capitalized on the first loan. On the second loan, SLPOC used the 4 million on 1st of August 2019. So from January to August, we are counting about 7 months. January to July, 7 months. August 1, that's when they started. So from August 1, September 1, October 1, November 1, December 1, we have 5 months. So the only months with activity were 5 months on the second arrangement. So we're going to get the 5 million, the 4 million, we multiply by the 8%, and then we multiply by the 9 over by the 5 over 12, which is going to give us 0.13 million kwacha. So now what we do, we have the two interest rates, 0.18 and 0.13. So what we do, we simply add these two interest rates to come up with the total interest rate of how much? Of 0.31 million. That is the amount of money you must be able to capitalize in your financial statement as borrowing costs. Is that okay, guys? That is the amount of money you must be able to capitalize in your financial statements as borrowing costs. Is that okay, guys? Is that okay before we move on? Those of you watching us from Facebook, for you to benefit fully, please you may kindly call WhatsApp that number on your screen, 0953 979798, so that you can subscribe and have the privilege of being able to see what your friends see at the digital board and other facilities that you can access on Facebook or YouTube. Okay, so Mr. Mumba says understood. Fantastic. So if that's okay, that means we need, of course, to check out something else. Of course, there's a comment from Facebook from Taizia who says, very well, thank you. Okay, so if you guys are understanding, man, that is fantastic. Okay, so anything else? Remember, sometimes you're going to find that in the examiner does something else. The examiner sometimes tells you that when they borrowed the money was put in the bank. And that money gained some interest. Or the examiner simply it was put in the bank and the interest rate was 10% or 5%. You must remember something. If you borrow money and then you go and put in the bank, that money gains interest. That interest is not income. Don't take that interest to the income statement. You'll be making a mistake because that interest is definitely not income. That interest should help you to reduce the borrowing costs. You must not go and put that interest in the income statement. No, simply take it to what you're supposed to pay and subtract from what you're supposed to pay, because that interest should help you reduce the borrowing cost. So you must remember that when dealing with a standard like this one. So guys, this was our standard for tonight. IS number 23, borrowing costs. We have done a few things. We have done 2 questions, one on specific borrowing, and then one we have done on general borrowing. So please, guys, remember to go through what we have discussed tonight. We also talked about 3 ways on which we can recognize our borrowing costs. We said number 1, when borrowing costs are being incurred, expenditure is being incurred, activities necessary for making the asset used for intended, making asset ready for intended use or sale are taking place, then we can recognize those borrowing costs. When to stop capitalizing? When asset is completed, when there's a major interruption, or simply when an asset is completed in parts. So the part is completed, we stop capitalizing it. Very important to remember. When we are dealing with a specific borrowing, what did we say? We said on specific borrowings, we are going to use the effective interest rate, where we simply multiply the borrowed amount with the interest rate. If we are dealing with the general borrowings, where a company has borrowed from different sources, we are going to use weighted average interest rates, where we simply multiply the borrowed amounts by interest rates, adapt the interest, and then get the full loan amount, then divide into the added interest to have the weighted average. That is the amount you're going to use by the funds which were used. So you must remember that. So guys, it's always a joy to be with you. I'm always grateful for your support. Thank you so much for those of you from Facebook. Mr. Piri Madaliso from Rwansha, thank you so much. Vana Shalin from Kabwe, thank you so much. You're a faithful follower. Taiza Siame, fantastic, awesome, thank you so much. Paul Manda Jr., who says, it's okay. Thank you so very much. And my lovely wife there. Yeah, that's Mamake Mumbi. She's in Ndola. She says she's watching from Ndola. Thank you so much, Susan Kachali, for following us from Ndola. We appreciate. And then we go to, those in class who've participated. Thank you so very much, guys, for your support. Yeah, we have other guys in class who have supported us, and that is really awesome. All right, guys. So this has been me tonight, and I really hope to see you again on Wednesday, where we're going to do another interesting and fantastic standard. You guys are awesome. Thank you so very much. It has been borrowing costs, IS number 23. So I expect you to do questions on borrowing costs. I'm going to give you assignments, of course. And then we're going to go through the assignments together again. Thank you so much, guys. Unless there's a question, I would like to say good night. Yes?
Apart from borrowing from different sources, is there any way an examiner can make us think we're either dealing with specific borrowing or general borrowing?
Yes, the examiner will tell you, if you are dealing with a specific borrowing, the examiner will simply give you one source.
Oh, okay.
When there are more than one source, then you know it's not specific, it's general.
Okay, thank you very much.
Sources. Fantastic. Thank you so much. So that was our standard for tonight. So guys, can I say good night? Is there something you guys want to tell me, like good night, have a lovely night, you're such a wonderful man, we'll see you on Wednesday and things like that? Anybody wants to tell me that? Guys from Facebook, do you want to tell me how wonderful I am? Anybody from class? Are you laughing at me or laughing with me? What's going on, you guys? How Bettina? Tawina, are you guys laughing with me? Oh, you're just
laughing with you.
All right, guys. So are you guys gonna tell me how wonderful I am and good night and things like that before I leave?
such a wonderful man, sir.
How did I know that? I'm such a wonderful
And
man.
caring too.
I'm such a caring man. Can you believe that? I'm flattered. She's nice. So, guys from Facebook, what do you think? Tell me through your comments. Before I go, can you tell me good night and things like that? You know. Oh yeah, you guys are awesome. I'm always good for support. You guys from Facebook and from class. Bye bye, guys. I'm gonna see you on Wednesday, same time.
All right.